Have you ever wondered what bonds are and how to invest in them? Well, let's dive into the world of bonds together. In the simplest terms, a bond is a loan, but unlike the typical loans you think of, with a bond, you are the one lending money, not borrowing it. Now, who might you be lending to? That could be a corporation, a government, or even a municipality. Let's imagine for a moment. You've got some extra cash and you're not sure what to do with it. A corporation, let's call them Tech Titan, needs money to fund a new project. They issue a bond, which is like saying, "Hey, lend us some money and we'll pay you back with interest." You decide to buy that bond. Congratulations, you've just become a bondholder. Now, what you need to know is that there are different types of bonds. First, there are corporate bonds, like the one from our Tech Titan example. Corporations issue these to raise money for a variety of reasons, such as financing new projects or expanding operations. Then we have government bonds. These are issued by national governments. In the United States, for instance, the federal government issues treasury bonds to fund its operations and projects. Other countries have similar systems. Lastly, we have municipal bonds. These are issued by states, cities, or other local entities to fund public projects like building schools or highways. Each type of bond comes with its own set of characteristics and risk profiles. Corporate bonds tend to offer higher interest rates but come with a higher risk. Government bonds are considered safer but offer lower returns. Municipal bonds, on the other hand, are a bit of a mix. They offer tax advantages but can be riskier than government bonds. Now that you understand what bonds are, you might be wondering, how can I invest in them? Well, stay tuned because we're just getting started with bonds. Before we dive into the details of investing in bonds, if you're finding this video helpful, don't forget to subscribe and like this video. It helps us bring more informative content to you. Isn't it amazing how much we can learn together? Each click, each like, and each share not only supports our work, but also spreads knowledge far and wide. Helping each other grow, that's the true essence of this community. Subscribing ensures that you're always in the loop with our latest content. Plus, liking the video is your way of telling us that you appreciate the effort we put into these sessions. It motivates us to keep producing quality content and tailoring it to your needs. So, take a moment. Click on the subscribe button, hit the like button. It's just a small tap for you, but a giant leap for our community. All right, now back to bonds. Let's get into how to invest in them. Investing in bonds isn't as complicated as it might seem. It involves a few simple steps. Let's dive in, shall we? The first step in this journey is to research the type of bonds. There are several types out there, each with its own unique features and benefits. For instance, government bonds are considered the safest as they are backed by the full faith and credit of the government. Corporate bonds, on the other hand, offer higher returns but come with a higher risk. Then there are municipal bonds, which are issued by local governments and offer tax advantages. Understanding these differences is crucial in making an informed decision. Once you've familiarized yourself with the types of bonds, it's time to determine the level of risk you are comfortable with. This is often referred to as your risk tolerance. If you're a conservative investor and prefer stability, then low-risk government bonds might be your best bet. However, if you're willing to take on more risk for potentially higher returns, then corporate bonds could be the way to go. Having determined your risk tolerance, the next step is to find a broker or online platform through which you can buy the bonds. There are plenty of options out there, from traditional brokerage firms to online trading platforms. Some platforms even offer educational resources to help beginners understand the process. When choosing a platform or broker, consider factors like fees, customer service, and ease of use. Now comes the exciting part, purchasing the bond. When you buy a bond, you're essentially lending money to the entity issuing the bond, be it a corporation or a government body. In return, the issuer promises to pay you interest at a predetermined rate and to return the principal amount at maturity. This is where you start to see your investment grow. Before you make the purchase, however, it's important to read the bond's prospectus. This document contains vital information about the bond, including the interest rate, maturity date, and potential risks. You need to ensure that the terms align with your investment goals and risk tolerance. After you've done your due diligence and made your purchase, the final step is to monitor your investment. Keep track of interest payments and any news related to the issuer. This will help you make informed decisions about whether to hold on to the bond until maturity or sell it before then. And there you have it. You've successfully invested in a bond. But remember, investing is always a risk. So, is investing in bonds a good idea? Scene script. Like any investment, bonds have their pros and cons. Let's start with the positives. First off, bonds provide regular income. When you purchase a bond, you're essentially lending money to an entity, usually a corporation or government. In return, they agree to pay you interest at fixed intervals, often semi-annually or annually. This makes bonds a great choice if you're looking for a steady income stream. Second, bonds are generally considered less risky than stocks. Unlike stocks, where returns are uncertain and depend on a company's performance, bonds promise to return the original amount, known as the principal, at a specified maturity date. So even if the entity you lent to doesn't perform well, you're still guaranteed to get your initial investment back, provided they don't default. But just as there's no such thing as a free lunch, bonds also come with their share of drawbacks. For starters, bonds typically offer lower returns than stocks. While they provide stability, this often comes at the cost of higher potential profits. This means that if you're a risk taker looking for significant growth, bonds might not be your cup of tea. Another potential downside is interest rate risk. When interest rates rise, bond prices fall. This is because new bonds issued will carry the higher interest rate, making existing bonds with lower rates less attractive. If you need to sell your bond before it matures, you could end up getting less than what you paid for it. Lastly, there's the risk of default. While it's not common, if the entity you lent to is unable to repay their debt, you could lose some or all of your investment. In conclusion, bonds offer regular income and are less risky than stocks, but they also come with lower returns and interest rate risk. It's important to weigh these factors before making your investment decision. So, you now know what bonds are, how to invest in them, and the pros and cons of bond investment. We've journeyed through the world of bonds, unraveling its complexities and shining a light on what can be a very profitable investment avenue for many. To recap, bonds are essentially loans that you, as an investor, give to an entity, usually a government or a corporation. In return, you receive interest payments over the life of the bond and the principal upon maturity. They serve as a reliable source of fixed income, especially for those seeking a more conservative investment strategy or for those looking to diversify their portfolio. Investing in bonds is not a complicated process. You can buy bonds directly from the issuer during the initial offering or on the secondary market from other investors. There are also bond mutual funds and exchange-traded funds that provide access to a diverse collection of bonds in one fell swoop, simplifying the process and spreading the risk. However, like any investment, bonds come with their own set of risks. Interest rate risk, credit risk, and inflation risk are just a few that investors need to consider. The value of a bond can fluctuate depending on economic conditions, and there's always the possibility that the issuer might default on their payments. That's why it's so essential to do your research, to understand the bond issuer's creditworthiness, and to consider how a bond fits into your overall investment strategy. You should consider consulting with a financial advisor to ensure you're making the best decisions for your financial future. Investing is not a one-size-fits-all endeavor. It's about finding the right balance between risk and reward that fits your financial goals and risk tolerance. Bonds can be a great addition to your investment portfolio if they align with your investment objectives and risk tolerance. Remember, every investment comes with a risk. Always do your homework before diving in, and don't forget to hit that subscribe button for more financial insights. Until next time, happy investing!